Hey everybody, what's going on? Today we're going to talk about everyone's favorite topic, bond amortization of discounts and premiums. Really quick, this is a longer video tutorial. If you want to skip around or have a specific example that you are looking for, take a look at the timestamps here and feel free to skip ahead if needed. If you find you're really struggling with bonds, I highly suggest to watch the whole video so that you can understand the whys of what we're doing, and the journal entries and the amortization and tables will make so much more sense. Without further ado, let's get into this. Why do we have to amortize? This is the face that I get, or I used to get, when I would see these types of problems in the CPA exam or an accounting class. I'd cringe and ask why we even have to do this, right? When we issue a bond at par, it's super straightforward, right? We debit cash, credit bonds payable. There's no discount, no premium. And then the interest payment journal entry is very simple, very straightforward. We're just debiting interest expense and crediting cash. Why can't it be that easy all the time? I'm going to do my best to explain why here with a quote that I hope I'm famous for. Why should accounting be easy when we could make it hard? Okay, just kidding. That's stupid. Awful joke. But really, it all comes down to a variation in interest rates. This is why we have discounts and premiums on bonds payable. And I'll try to illustrate that with a little example here. So pretend you know Bob. Bob comes up to you and wants to borrow $100. Bob will pay you back the full $100 in 1 year. Each month of the year, Bob will pay you $1 in interest. So at the end of the year, when he pays you back, you'll have made $12, $1 for each month of the year. Now we're going to assume that Bob is the only one out there offering loans or looking for a loan. And so we're going to assume that Bob is offering the market rate right now, or the effective rate, right? So if he's paying $12 a year for this money, it's going to be at 12%. But it's really important that we know that Bob's the only one paying or asking for a loan right now. Then Tim comes along. And Tim says, hey, I want to borrow $100 too. I'll pay you back in the full $100 in 1 year from now. But instead of a $1 a month, Tim says he's going to pay you $2 in interest every month. At the end of the year, that's $24. That's twice as much money that Bob was going to pay you in interest. So if you had the option between these two deals to loan Bob or Tim $100, which one would you take? Right? It's obviously going to be Tim, right? Because he's going to pay you double the amount of money in interest. You're going to make $24 as opposed to $12 for loaning the same $100. So what does this have to do with discounts or premiums or bonds? Well, let's take a look here even further. So this is such a good deal, right? Tim's deal is so much better than Bob's that no one would ever take Bob's deal, right? There might be people fighting over Tim's deal, right? So you see here, someone in the pink bubble comes up and says, hey Tim, I'll give you $105 for that deal, and you only have to pay me back $100. And that sounds a little crazy, right? But before, Bob was our only option. The only option we had was to make $12. So this person in pink comes up and says, hey Tim, I'll pay you even a little bit extra so that I can give you the loan. This means he'll get $24 in interest, but he paid $5 extra, or you could say a $5 premium for that bond. So he still gets a profit of $19. This is higher than what Bob was offering, higher than the market was offering, so it's still a lucrative deal. But then, watch out, somebody else comes up and says, hey, no Tim, I'll give you $110 for that deal. You only have to pay me back $100. This is still a pretty good deal, right? Because Bob's deal was only going to get you $12 of interest. But in this case, the person in green is going to pay a $10 premium. There's still a profit of $14. $24 in interest from Tim minus the $10 premium, or the $10 extra paid. So this is still a better deal than Bob's. And again, Bob's was the market. Bob was the norm. And here we go again, once more. Someone says, wait, Tim, hey, I'll give you $112 for that deal. You only have to pay me back $100. Now, this is where we hit equilibrium. This is where we hit Bob's effective rate. With the $24 in interest and $12 in premium paid, now there's only a profit of $12. Now there is no difference, no effective difference between Bob and Tim's deal. And this is what happens with bonds, guys. This is why bonds are issued at a discount or at a premium. It depends what the current market rate is, the effective market rate is, and the stated rate on the bond. Tim was offering way more interest. His stated interest rate was way higher than Bob's, the current market rate. So Tim's bond sold at a premium, and it sold at a premium because the better interest rate caused people to bid up the price of his bond until it was equal with Bob's. It's kind of like supply and demand here. And if we flip the scenario, right? If Tim was the going rate, if he's the only one that we knew about first, and he was offering $24 in interest, and all of a sudden Bob comes along and offers 12, nobody will be interested in Bob's loan, right? His bond. What will happen is people will bid downwards. That's probably not the best way to say it, but people will try to get a discount, and they'll chip away down to a discount that equals the effective interest rate that Tim was offering, or else it probably won't sell. So again, here at the bottom, what happened? The difference between these, why do we have premiums? Why do we have discounts? It's because of a variation in interest rates. It's the relationship between the stated rate on the bond or the loan and the current market or the effective rate. And we know that due to supply and demand, the stated rate will always be bid down or bid up to essentially equal the effective rate. I hope that helps explain a little bit why we have these premiums and discounts in the first place. And this is just a summary really quick, and this will help you when you're going to answer questions on the CPA exam. A bond is issued at par value when the stated or the face rate equals the market rate or effective rate. Bonds issued at a discount when the stated or face rate is less than the market or effective rate. And bonds are issued at a premium when the stated or face rate is greater than the market or effective rate. Sweet. Now we're going to move on to an example here. We are going to look at a bond that's issued at a premium using the straight line method. So remember really quick, there are two methods on the CPA exam that you'll need to know. The straight line method, which we'll start with, and the effective interest method. Generally, students tend to think the straight line method is a little bit easier, and you'll see that why in a second. The effective rate has a few more calculations and a few more steps involved, but we'll get to those examples later. So let's get started. Bond issued at a premium using the straight line method. Thomas & Co. issues $1 million in bonds and receives proceeds of $1,085,302. The stated rate on the bonds is 8%. The effective rate is 6%. The bonds were issued on January 1st, year 1, and have a 5-year maturity. Interest is paid semi-annually on June 30th and December 31st. And it's asking us on this slide to record the journal entry for the bond issuance. So when we're recording the journal in either method, this entry will be the same. When I'm recording this bond issuance, I like to pick out the easy parts first. I like to look for the low-hanging fruit. For me, the first one is going to be proceeds, okay? When you're issuing a bond, the proceeds, the cash that you get, is the easiest part of the entry. So we know we're going to have an entry to the cash account because we're receiving cash. And that's going to be the amount of the proceeds. $1,085,302. The second part that I like to go to next is the actual amount of the bonds. It says we issued $1 million in bonds. So we know that we'll have bonds payable, and that's a liability, so we will credit that for $1 million. So right now our debits and credits don't equal each other. I'm not quite, maybe you're not quite sure what the next part of this entry is. So we at least have a plug here, right? To balance this journal entry out, we have to have a credit of $85,302. But what is that? If you guessed, it's the bond premium. So this was the difference between the proceeds that we received and the bonds payable face value or face amount. We received $85,302 over the amount of the face. This is kind of like the example we looked at the beginning with Tim. The stated rate is 8% here, which is more than the effective rate of 6%. This means that we will have a premium. The other obvious sign that we have a premium as well is that we received more than the face value. If we received less, that would be a discount. And then if the stated rate was less than the effective rate, then we'd have a discount. But it's also really helpful here to use the journal entry to your advantage. If you didn't know or if you couldn't remember which side the bond premium went on, if it was a debit or credit, once you have your cash and your bonds payable, simply look to see which side will balance the entry, which plug will give you a balanced journal entry. Next, this asks us to record the journal entry for the interest payment on June 30th of year 1. So when we're recording the interest payments here, we're going to be dealing with 3 accounts. We're going to have interest expense. We know in accounting that expense accounts are debited. So we should have a debit here. We have the bond premium account. So we have to amortize that premium that we recorded in the first journal entry over the life of the bond. Right now at this point, we might not be sure. Do we debit that? Do we credit that? So we'll come back to that for now. And cash. We know that we're making a cash interest payment, and a decrease in cash is a credit. So again, we know there's a debit to interest expense. We know there's a credit to cash. We're not sure about bond premium yet, but we're going to have to do some calculations to find out these amounts. So let's take a look. Let's start off with the cash payment. That's generally going to be the easiest. To find the cash payment, we take the face value of the bond times the stated rate, or the face rate. So in our example here, we take $1 million issued in bonds times 4%. Now that 4% might confuse some of you because it says the stated rate on the bonds is 8%. So how do we get that? Well, the annual rate on the bond is 8%. But remember that interest is paid semi-annually. That's twice per year. So it's actually paid at 4% twice per year for a total of 8%. So this is a really easy mistake to make on the exams. It's super easy to get caught up and try to solve the problem too fast and make this mistake. But make sure if the bond is semi-annual that you divide that interest rate by 2. So again, to get the cash payment, we take $1 million times 4% for a cash payment of $40,000. The next part that we're going to do here is we're going to calculate the bond premium. Under the straight line method, this is relatively easy. We take the total bond premium, which we found in the first journal entry, and divide by the total amount of periods. So the total bond premium was $85,302. Again, that was the difference between the proceeds and the $1 million issued in bonds. And we divide that by 10 periods. And again, this one might throw you for a loop for a second too. You might be thinking, hey JP, like the maturity said after 5 years. Why don't we use 5? Well, again, interest is paid semi-annually. So 2 periods per year at 5 years equals 10 periods. So we're going to divide that 85,302 by 10 periods to get 8,530 in amortization per period. And if you're familiar with depreciation and comfortable with that, you'll notice that the straight line method for amortization is very, very similar to straight line depreciation. So once we have this rate, we're going to use this same rate every interest payment that we make. Okay, we're going to come back to interest expense, so let's go put these two values in our journal entry. So we said the cash payment, $40,000, that's a credit. And then we said the bond premium. Since we're doing bond premium first, we don't quite know our plug if it's going to be a debit or credit. So let's take a look at the first journal entry we did to see how this relates. When we recorded the bond premium, we recorded a credit. Over the life of the bond, we want to reduce that bond premium. We want to bring it down to 0 so that the net carrying value of the bond at maturity is only $1 million. Right now, the net carrying value is $1 million plus the $85,000 in bond premium. So originally, we credited the bond premium for $85,302. But over the life of the loan, we want to decrease that. We want to reduce the bond premium until it is down to 0. So if we originally credited that amount, this time we want to debit. So our bond premium is going to be debited for $8,530. Now to go back to interest expense, we know in this case it'll be our plug for the entry, so we could find it out that way, but let's see how it is calculated. The interest expense in this case is calculated as the cash interest payment minus the bond premium amortization. So that's $40,000 that we calculated earlier minus the $8,530 of bond amortization. So that gives us interest expense of $31,470. We go back and plug that in our entry and we are all balanced now. So you might be wondering here, why is interest expense, not simply the cash payment like when it is when a bond is issued at par? And the reason for this is the bond premium, really. So if we imagine that the interest expense starts at $40,000, we're actually reducing it by the bond premium amount. Over the life of the bond, we'll be paying $40,000 in interest every single period, but the $85,000 that was paid over the total amount of the bonds is kind of like a bonus. It's kind of extra. We were given $1,085,302, but at the end of the bond's life, we only have to pay back $1 million. So we actually received extra money. So that extra $85,000 is going to offset interest expense throughout the life of the loan. And in case of straight line method, it will reduce the amount of interest expense evenly over the life of the loan. So by debiting bond premium, we're reducing the amount that goes into interest expense. Again, because we received a premium and we received extra money that will kind of offset the interest expense that we're paying out. It's good to note here that this journal entry will be the same for all 10 periods when the interest payment is made. That's what's nice about the straight line, is every single journal entry, all 10, will look just like this one. This is not the case when you're doing the effective interest rate method, so please make note of that as you're learning. Now here's a good tool here. We're going to look at the amortization table as a whole. Note that the beginning net carrying value is $1,085,302. Those are your proceeds. We calculated the interest payment of $40,000, the amortization straight line rate of $85.30, and then we subtracted the $85.30 from $40,000 to get the interest expense. Again, this is the exact same in the straight line method every single period. One other important item to note is the end and net carrying value. Sometimes they can ask you for this on the CPA exam. We got the end net carrying value for period 1 by taking the beginning net carrying value of $1,085,302, and then we subtracted the amortization of $85.30 to get the new net carrying value. And again, this is kind of like what we talked about. We're slowly amortizing, we're slowly chipping away at that premium one period at a time. And you'll notice as you go down the periods closer to 10 in the bottom right hand corner, the eventual goal is to get to the face value, is to get to that $1 million. So as we slowly amortize, as we decrease it equally over the life of the bond, we eventually arrive at the face value. I'll remind you one more time, the journal entry is the same for all 10 periods under the straight line method. Now we're going to record the journal entry for bond maturity. This is going to be pretty simple. We're just going to reverse what we did at the very beginning of the period. Now that we amortize the premium all the way down to 0, we simply debit bonds payable to reverse the credit earlier of $1 million, and then we're paying back that bond the principal. So we're going to credit cash for the $1 million payment. Here are the journal entries that we did as a summary if you want to pause and look at these for a second. Number 1 is the bond issuance. Number 2 is the interest payment journal entry, and again, that one happens 10 times. And it stays the same each time, the straight line method. And then the third journal is the bond maturity. Okay, now we're going to go to the next example. It's going to be a bond issued at discount using the straight line method. Okay, we have a little bit of change here in the example problem. So now Thomas & Co. issues $1 million in bonds and receives proceeds of $957,350. So right off the bat, even if I didn't tell you, you would know that this bond was issued at a discount because the proceeds are less than the face value of the bonds. The stated rate on the bonds is 5% and the effective rate is 6%. This also tips you off to tell you that this was issued at a discount because the stated rate is less than the effective rate. The bonds were issued on January 1st, year 1 and have a 5-year maturity. Interest is paid semi-annually on June 30th and December 31st. So the maturity and the periods will stay the same. Record the journal entry for bond issuance. This journal entry will partly be the same, but we have a little change. So again, I like to start with cash. That's always the easiest for me to follow. I know that we received proceeds. We received cash of $957,350. We'll debit that. I know that we issued bonds, so we're going to have a credit to bonds payable for $1 million. Now here, again, use the journal entry to your advantage. We know they have to balance. We know we need a plug in the debit column. We know we need $42,650. What's this going to be? It's going to be bond discount, or discount on bonds payable. $42,650. We got this by subtracting the proceeds from the bond issue amount. So the amount that we collected that was less than the face value was $42,650. Now, record the journal entry for the interest payment on June 30th of year 1. Okay, again, let's start with the accounts that we need in this journal entry. We're going to have interest expense. We're going to have bond discount because we need to amortize that discount. And then we're going to make a cash payment on this interest payment. So we have cash. Now let's go look at how we calculate those. Again, let's start with cash because I think it's the easiest way to get started. Again, we're going to take face value of the bond times the stated rate, or the face rate. We'll again take $1 million and multiply it this time by the stated rate, 2.5%. Again, this is half of 5% of the stated rate because this is a semi-annual bond payment. We don't use the 5% because that's the annual rate. We're looking for 6 months of interest only. So $1 million times 2.5% is $25,000 for our cash payment. Next, we'll move to the discount. We find this by, again, taking the total bond discount and dividing by total period. So you'll see this is very similar to what we did with the bond premium in the straight line method. So we take the $42,650 divided by 10 periods. That's, again, 5 years, 2 periods per year. This gives us $4,265 that we're going to amortize on our bond each period that we make the interest payment. So let's go back to our journal entry. Again, we have cash. Decrease in cash is a credit of $25,000. And for the bond discount, this is kind of the tricky part of the journal entry. Where do we put this? Is it a debit or is it a credit? Well, if we look back at the bond issuance journal entry, we debited the bond discount to start out to record it. And again, this matches up with our net carrying value. The net carrying value is $957,350. It's $1 million less the bond discount. Net carrying value is found either by adding the premium to the face value or subtracting the discount. So again, we recorded a debit to the bond discount, and now over the life of the bond, just like the premium, we want to slowly reduce that bond discount amount. We slowly want to amortize it so that at the end of its life, that account is at 0, and the face value, the net carrying value, becomes $1 million. So we started with a debit. Now when we amortize, we're going to do the opposite. We're going to credit for $4,265. Now interest expense here, again, is going to be left with our plug. So we know that if we add up the credits, interest expense will be that amount, but let's see how that's calculated. Interest expense here is calculated as cash interest payment plus the bond discount amortization. $25,000 cash payment plus the $4,265 that we calculated earlier for $29,265. This goes in our debit for interest expense. So you'll see that this entry is a little bit different from the bond premium, and that's because of the natural balance of the bond premium account versus the balance of the bond discount. Again, just like with the premium in the straight line method, this journal entry will be the same for all 10 periods, for all 10 interest payments. Here's a look at our bond amortization table again. The beginning net carrying value, like we said, was $957,350. We calculated our interest cash payment of $25,000, and we calculated the amortization rate of $4,265. Then we added those together to get our interest expense, $29,265. To get our end net carrying value of $961,615, we simply took beginning net carrying value and added the amortization. So last time for premium we subtracted because we were above $1 million and we wanted to come down to it. But now with our discount, our carrying value is below $1 million of face value, and we want to bring it up to $1 million. So you'll see that we add the amortization in this case. Note again, as you can see in each column, the journal entry is going to be the same for all 10 periods, and that's the really nice thing about the straight line method. Record the journal entry for bond maturity. This will be the same as it was for the premium. debit bonds payable for $1 million and credit cash for $1 million. Again, here's a look at the journal entries that we made for this example. If you want to pause and take a better look, we have number 1 was the bond issuance. Number 2 is the interest payment or the interest expense that happened 10 times throughout the life of the bond. And then number 3 is the bond maturity. Okay, now we're going to take a pivot here from the straight line method and go over to the effective interest method. This method is a little bit complicated, a little bit more complicated than the straight line method, but again, I'm confident that we can go through this and make it a little bit more easy to understand. We're going to start with a bond issued at a premium using the effective interest rate method. Thomas & Co. issues $1 million in bonds and receives proceeds of $1,085,302. Again, we know that it was issued at a premium because proceeds are higher than face value. The stated rate on the bonds is 8%. The effective rate is 6%. We know again that this is a premium because stated rate was higher than the effective rate. The bonds were issued on January 1st, year 1 and have 5-year maturity. Interest is paid semi-annually on June 30th and December 31st. Okay, so again, I always like to start with the cash in this case. And our entry here is actually going to be the same as it were if we were doing the straight line method. So we'll debit cash for the proceeds, $1,085,302. We're going to credit bonds payable for $1 million, the face value. And then our plug to make the journal entry balanced is going to be the $85,302, which is the bond premium like we talked about earlier. Now this is where things will get a little bit different. We're going to record the journal entry for the interest payment on June 30th of year 1. We're going to use the same accounts as we've been using before. We're going to have interest expense, a debit, bond premium, and we're going to have a credit to cash. So let's take a look how it's calculated using the effective interest rate method. If we start with cash, this is actually going to be calculated the same way, right? The bondholder is going to receive the same cash payment regardless of what method that you're amortizing with. So this is going to be the face value times the stated rate or the face rate. Again, this was $1 million times 4%. That's the stated rate of 8% divided by 2 for semi-annual payments. 1 million times 4% equals $40,000. And here's where things change. Instead of calculating the bond premium next, we are actually going to calculate the interest expense. So under the effective interest rate method, we will take the net carrying value times the effective interest rate. So this is where the effective rate comes into play. When we were doing the straight line method, the effective rate did not matter. We didn't use that rate for anything. It was totally irrelevant. The effective rate can be there to trick you while you're doing the straight line method, but we actually do need to use it here in the effective interest rate method. So the net carrying value of our bond here is $1,085,302. It's generally the amount of the proceeds. It's also calculated the same way by the face value of the bond, $1 million plus the premium. So it's the same number, but you can look at it 2 different ways. So the carrying value of $1,085,302 times 3%. Again, you have to divide the 6% rate by 2 so that you get the semi-annual rate. When we multiply those together, we get an interest expense of $32,559. So let's go plug these numbers in our journal entry. We have the cash payment of $40,000, and then we have the interest expense of $32,559. We know now that we can see this. To get the entry to balance, we're going to have a debit to the bond premium. And this makes sense because originally for the premium we credited it, and now we need to amortize it and reduce it back down to 0 over the life of the bond. So we're going to debit bond premium in this example. But let's see how we calculate it. Bond premium is calculated as the cash payment minus interest expense. So that's going to be $40,000 cash payment minus the interest expense that we calculated of $32,559. That's a bond premium amortization of $7,441. So we go back and put this in our journal entry here with a debit, and now we'll see that our entry is balanced. We're going to take a look here at the bond amortization table. And you'll notice this is a big difference too between the straight line method. We had the interest payment of $40,000, and that does stay the same throughout the life of the bond. But here, interest expense and amortization are constantly changing. That's because when we decrease the end and net carrying value, we take $1,085,302, and then we subtract $7,441 to get our end and net carrying value. We're slowly working our way towards $1 million, slowly decreasing the net carrying value back to the face value. But then next period, you'll notice with the way we calculate interest expense, we take the 3% times the new beginning net carrying value of $1,077,861. So interest expense is constantly reducing or getting smaller over the life of the bond, and inversely, amortization expense is getting bigger. So this is really important to note because on the exam, if they ask you for the second or third period amortization or the journal entry, you will actually have to do the first two periods to figure out what the third period would be. In the straight line method, it's very simple in that they're all the same, but as you take a look here at the bond amortization table, that's not the case. As net carrying value gets lower with a premium, the amortization gets higher, and those two numbers will fluctuate, so your journal entries will be different every single period. And we make that note right there. Record the journal entry for bond maturity. This is the exact same way as the straight line method. Debit bonds payable for $1 million, credit cash for $1 million. Here's a look at our three journal entries again. Number 1 was for bond issuance. Number 2 was for the first interest payment. Remember that journal entry does not replicate exactly the same every time. The accounts will be the same. You'll debit interest expense and bond premium, but in credit cash, but interest expense and bond premium will be changing each period. And number 3 is bond maturity. Okay, last example here, we're going to go with a bond issued at discount using the effective interest method. Thomas & Co. issues $1 million in bonds and receives proceeds of $957,350. The stated rate on the bonds is 5%. The effective rate is 6%. One more time, we know that this is a discount because the proceeds were less than the face value. We also know because the stated rate of 5% is less than the effective rate of 6%. The bonds were issued on January 1st, year 1, and have a 5-year maturity. Interest is paid semi-annually on June 30th and December 31st, so those terms stay the same as well. Again, same as before with the straight line method. We have a debit to cash of the proceeds, $957,350, a credit to bonds payable of $1 million, and again, the plug here, $42,650, is going to be a debit to our bond discount. All right. Next, record the journal entry for the interest payment on June 30th of year 1. These are the accounts that we're going to use again. We have a debit to interest expense, we have bond discount, and we're going to have a credit to cash. So let's see how those are calculated. Cash, face value times stated rate. This is the same as before. $1 million times 2.5% equals $25,000. Again, we use the 2.5% because it's the 5% annual rate divided by 2 for semi-annual payments. Next, we have interest expense. Net carrying value times the effective interest rate. So this time our net carrying value again is the proceeds that we start with. $957,350 times 3%. That's the semi-annual rate, 6% divided by 2 or 3%. $957,350 times 3% equals interest expense of $28,721. So if we go plug those amounts into our journal entry, we get the cash payment of $25,000 as a credit, and a debit to interest expense of $28,721. We know now that the bond discount is going to be our plug, and we need a credit, so we're going to credit that account because originally we debited the bond discount, and we're slowly decreasing it over the life of the bond. So to undo that debit, we're going to constantly credit each interest payment. To calculate that, it's going to be interest expense minus the cash payment. $28,721 minus $25,000 equals $3,721. And that is our credit to balance this journal entry. Okay, here's our amortization table. Again, note that the journal entry is different for all 10 periods. Under the effective interest rate method for both premiums and discounts, the amount of the journal entry will change. As beginning net carrying value with a discount goes up and gets closer and closer to face value, interest expense will go up each period, and amortization amount will go up as well. The interest payment of $25,000 will stay the same each time. Here's the journal entry for the bond maturity. We're going to debit bonds payable for $1 million, and we're going to credit cash for $1 million. Here are 3 journal entries, so you can take a pause and look at it if you need to. Number 1 was the bond issuance. Number 2 is the interest payment for the first period. Again, I'll hammer home that this changes each period under the effective interest rate method. So this is for the first period only. And number 3 is the bond maturity. I hope these examples helped you clarify bond amortization a little bit. If you have any extra questions, please feel free to leave a comment below. I'm happy to answer your questions. If you want to shoot me an email as well, please do that. Reach out on my website. If you like this video, I highly recommend to check out this one as well. It'll help you answer multiple choice questions faster and get through questions a little bit quicker using a tip that I found while I took the exams. Thanks again for watching, and good luck with your studying.